more dense, more links. Okay, so it's a simple diagram to summarize the rapid increase in interconnections among banks that have global operations just from 1985 to 2008. And a major factor is the securitization of mortgage loans. Okay, the more that we have packaged different individual mortgages into one new security and make that a new investment product that is sold not only within the US but internationally. So the objective of this particular part of the study is simply to report on the progress of implementation, to review studies or surveys that evaluate how useful the living will or resolution plan idea is, to evaluate whether the reduction of systemic risk is better achieved through, there are two different philosophies. One is structural regulation, which just says separate them out. If you're a bank, you should just do banking. If you're an investment bank, you focus on investment banking. If you're an insurance company, you do only insurance. And behavioral regulation, which is what the Dodd-Frank Act of 2010 is basically doing. It assumes, just like a parent says, I know you children will misbehave, and I cannot control that, so what I'll do is minimize the negative consequences by, in the case of banks or other financial institutions, I'll require you to maintain adequate capital, or I'll require you to maintain enough cash. And lastly, as this provision says, you have to provide me every year a living will, okay, to describe how complex you are, and I'll go over what exactly the content is. Okay, so going back to the idea of the clean balance sheet, which is desirable for making the death or resolution of a financial institution easy. So, starting January of 2019, if the Trump administration does not succeed in repealing this Financial Reform Act, we call it the Financial Reform Act of 2010, the central bank in the US, or the Fed, will require the parent of this bank holding company to maintain a clean balance sheet, which means the assets of the parent are limited to cash and other liquid assets and only investments in their subsidiaries. They should have a high level of loss absorbing capacity debt, meaning good quality debt with security, and they should issue convertible long-term debt, which is viewed as desirable because the bonds can be converted into stocks so that it can provide the new capital should there be a need to reorganize a financial institution that's in distress. And the third requirement is that they should not issue short-term debt. Short-term debt is problematic because the maturity is very short, and the obligation to pay back the debt is more frequent than if it had longer maturity. And they should stay away from derivative transactions with other than their subsidiaries. And fourth, minimize the financial connections between the bank holding company and its subsidiaries. Skip that. So the living will, which is one of the two major provisions, has a public section that is available for everyone to see through the website of the central bank and the FDIC, and also a confidential section. As far as the public section, the financial institution, or the CFI, has to publish who the principal officers are, organizational structure, starting from the board of directors and the top management. Who are the material or important, significant subsidiaries and what are their business lines? Their foreign operations, who are the regulatory agencies, not just within the US but abroad in other countries where they operate. Their memberships in payment, clearing, and settlement systems, their assets, liabilities, capital, and major funding sources. They have to publish the balance sheet and income statement anyway, so that part of it is not very new. But then they have to be transparent about their derivatives and hedging activities rather than